Thank you guys for tuning in to part 2 on the top 10 myths of stock and trading. So today we're going to go over 10 more new ones. All right, let's just get right into it. So the first one I want to talk about is you can always tell when a stock hits the bottom. This form of investing is called bottom fishing, and what people have noticed is it usually takes about 2 to 3 years for a stock to turn around. So when it's going down, yes, it may bounce back maybe 5% or even 10% or sometimes even more, but it'll still continue on its downward trend. Next is it's only $3 a share. What can I lose? This idea gets a lot of people into trouble, mostly because they assume the stock is so cheap that they can afford to lose it if it goes down. But if you invest $100 into a $3 stock versus buying one share of a $100 stock, if it goes to $0 in both cases, no matter what, you lose all of your money. So just because it's a cheap stock doesn't mean it's a good buy. Next is the idea that it's always darkest before dawn. A lot of people assume that, oh, it's just going through a really hard time right now, it's gonna bounce back. But an example I like to give is in 1981, there are about 4,520 active oil rigs. In 1984, there's only 2,200. People assume that since it had almost cut more than in half, that it'll start to come back. But in fact, 2 years later in 1986, it went down to only 686 active oil rigs. Next I want to talk about is when it rebounds, I'll sell. Now this ideology is even worse because a lot of people assume that when they buy their stock at, let's say, $10 and it drops down to $7, they're like, oh, okay, I'll sell it when it gets back to 10. But more often than not, it actually never gets back to $10 a share. And instead, you lose out on even more of your capital when you could have reinvested into a better stock that could have went up tenfold. Next, we're going to talk about how conservative stocks don't fluctuate much. Now this one is also bad. They assume just because it's a safe company that it can't fluctuate and that it'll always generally keep rising. A lot of people do this with utility stocks. They convince themselves that since utility stocks are a necessity that they'll never be able to fluctuate too much. But a great example is the stock of Edison when they lost 80% of its value. The next myth I want to go over, that if a stock goes up, it means you're right, and if a stock goes down, it means you're wrong. That's also not true. People base their accuracy on their winners and losers. Whether they chose a $5 stock going to $10 and a stock that went from $6 down to $2. It may not be true that one was right or the other. A great example of this is in 1981. Everybody assumed that Zappa was a great stock. They were the leader in their industry and they were trading at $35 a share. And their competitor, Ethel, was a bad stock and they were only trading at $2 a share. And what ended up happening is their stock, Ethel, went from $2 to $32 and Zappa went from $35 to $2 a share. Next I want to talk about it's taking too long for anything to happen. Usually what happens with this case is people sell their stock just because there's no movement. And funny enough, the stock usually tends to jump up in price as soon as that happens. So a great example of this is Merrick. Between 1972 and 1981, they were only growing about 14% a year. But then after 1981, the next 5 years, they went up 4 times within those years. The next one I want to talk about is I missed out on this stock, I'll get the next one. Typically that usually doesn't happen as well either. A lot of people assume that when they miss Home Depot, they'll get the next stock that was like Home Depot, which was Scotty's. And instead, Home Depot went up to grow 5 times more when Scotty had their first IPO, and Scotty's only went about 20 to 25% during that time. Next, I want to talk about the myth that you have to cash in at 20% of your gains. This isn't true either, because most stocks, if they're a winner, they're going to stay being a winner and they're going to keep rising and rising and rising. So selling your stock at a 20% gain is a terrible thing to do. A lot of people sell their winners too early and keep their losers for too long. And lastly, I want to talk about, which isn't completely a myth in the sense that it is that people decide to look at all the money they've lost. They see how they've made a bunch of bad trades and assume that the stock market is terrible and it's unbeatable. You shouldn't base your performance solely on the fact that how much money you lost. Yes, there's a direct correlation. The better you are, the more money you make. But you're going to make errors when you're first starting out and you're going to lose some money. Understand that's part of the process and it needs to happen for you to make more financial gains. Thanks for watching. If you liked the video, leave a like, comment, and subscribe for more future content.